This is Think Smart with TMFG, your weekly podcast of what's newsworthy and relevant to everyday Canadians, with your host, Senior Financial Advisor Rob McClelland and Mike Connon of Assante Capital Management. Today on Think Smart with TMFG, Mike and I are going to be discussing why the Canada Pension Plan is great. Mike, before we get started on the CPP, I wanted to bring you up to date on a couple of things. I've been hard at work on my week off, and I actually went through and I decided I had to put a number on each of our podcasts. So now when you see a podcast, you'll actually know what number podcast it is. So this has taken me hours to do.
Do we know what number this is?
Well, this is actually podcast number 252. So somehow we missed number 250. We put it out there. We just didn't realize it was podcast number 250. So we've done 250 podcasts. Today's podcast is number 252. The other advantage of doing this thing is I got to see that some of our podcasts, we've repeated some information, so we're going to have a better chance of not doing that going forward. I was able to correct some of the content by using Grammarly and spell check. So where you see a description of what the podcast is about, you'll find it's much better written than it was originally. So that's an advantage to technology. Now, there's always something that could go wrong when someone like myself gets involved with the technology. And sure enough, you'll find this week for our subscribers, you're going to get 2 bonus podcasts that are actually repeats that got republished because the system said they hadn't been published in the first place. One of them is on private equity, which is a great podcast. I've listened to it. I think you'll like it. And another one is on the technology that's going on in the bond market. And I think you'll find that of interest. Both of them are relatively short, 12 minutes in length. So this week you'll get 3 podcasts.
Perfect.
Mike, the Canada Pension Plan. I think it's a great pension plan for Canadians. I thought it might be helpful to review why we think it's so great. What are some of the advantages of it? What are some of the unique features of it to help give our audience a better understanding of it?
It's been a hot subject on the news for last year because some provinces have tried to opt out, which seems a bit odd. It's one of the things that works pretty well in Canada. And when you hear a province wants to opt out of the CPP, it seems like an odd thing. But even if a province did opt out, they would still provide the same type of benefits as we're getting from the CPP. So it doesn't matter if your province decides to go in or out of it, it's what's going to be provided, and they're still very beneficial.
So let's talk about some of the basics. And I think the basics are important to understanding why we think this thing is so great. We'll start with contributions. So basically what happens is throughout your working years, you and your employer contribute a portion of your earnings to the Canada Pension Plan. These contributions are made on the earnings up to a maximum yearly limit, so it's not unlimited. There's a certain income level there where you're not going to get any more Canada Pension Plan. So everyone's treated equally in this pension plan because of that. Number 2, the contribution calculation period is based on your time working between age 18 and age 70. Okay? So that's sort of how you get your contribution. The more years you've actually worked and contributed, the bigger pension that you're going to receive.
I think it's based on something like 39 years of your best years in that time period.
And so if you look at 18 to 70, you've got a potential of 52 years. Now, you could also get it as early as age 60. So in theory, that's, only 42 years and you need 39 to get full maximum.
I guess the major thing that comes up in this is when you're talking about the employer and the employee contributions, it really becomes a no-brainer if you're an employee. It's a dream because your employer is doing 50% of it. You can have some questions when it's someone's working for themselves. They have to do both sides of this. But anyone who's in an employee situation, it's one of the greatest plans out there.
So, for example, let's look at the yearly maximum. So for 2024, the yearly maximum is $32,490 worth of income. So most Canadians are going to qualify. in terms of being able to get the maximum CPP. So you don't need to earn $100,000 to get the maximum. As long as you're earning, just under $33,000, you're going to get the maximum Canada pension plan. You can also, one of the other basics is you can take it as early as age 60, but you can delay it as long as age 70. And one of the advantages is if you continue to work past age 60, by delaying it every year, you actually increase the amount of benefit you're going to get by 6%.
It's actually gone up. It's 7.2% now.
You are correct.
Yeah, they brought that up a few years ago. So they looked at retirement ages of people, and they give you more of a benefit now for going past 65.
So let's look at sort of, come up with 10 reasons why it's so good. Number one is universal coverage. CPP covers almost all employed or self-employed Canadians, ensuring that a vast majority of the population has access to pension benefits at retirement. So that's huge. There's lots of companies you can work for and not have a pension. You could run your own business and not have a pension. But with the Canada Pension Plan, you're at least going to have a pension.
Yeah.
Financial security. What does that mean, Mike?
Financial security, CPP provides a stable source of income in retirement. It helps retirees maintain their standard of living and financial independence. And one thing I want to say is people get very confused between CPP and OAS. Now, CPP is something that you put into. It's your right to have CPP. And the government can claw back things like old age security because old age security is a government benefit. It's not something you paid into. So all of a sudden, if OAS goes and they say, we're going to claw back at, let's say instead of 90,000, we do 60,000, the government has the ability to do that. The government does not have the ability to mess with Canada Pension Plan because this is your money. This is a different fund that's kept separate. So people talk about clawbacks. There are no clawbacks on Canada Pension Plan. There are clawbacks in old age security. So I just want to make that clear because people always get very confused about it. They go, oh, I'm going to make too much money in retirement anyway. It does not get clawed back.
I think one of the things that I really like about it is its adaptability. And so what do I mean by adaptability? It's constantly been changing over time to improve it. And so right now, employers are having to contribute more to it. Canadians can contribute more to it to ensure that the benefit going down the road is even better. For a long time, if you were taking time out to raise a family, none of those years were credited to the Canada Pension Plan. Now those years get credited, so you at least get a benefit even though you were at home, raising your family. So you're not penalized because of that. Next, it's indexed to inflation.
It's a huge benefit.
So think of it this way. Over the last few years since COVID, basically everything's gone up sort of, call it 20%. We had really high years of 6%, but it's gone up almost 20%. Canada Pension, because of that, because it's indexed to inflation, has kept pace with that. So you're not falling behind. You're able to keep up with the higher prices of all the goods and services that we use. What's the fourth best feature, Mike? We call it contribution system.
It operates on a contributory basis, where contributions are made by both employees and employers during their working years. So ensuring that each individual have a stake in the retirement benefits. So both your employer and you are both making contributions to this plan. So that's where we talk. It's a real no-brainer. If you're an employee, you're getting 50% of your retirement CPP paid for by your employer.
Let's compare that to an RSP account. If I put $10,000 into my RSP account, we don't have an RSP match program at our company.
Yep.
So I'm the only one putting the money in.
Well, we do.
Well, we do for our employees, but
yeah.
you and I don't as owners of the business.
Yeah.
So we're penalized that way. The next one is professional management. You don't have to figure out how to manage the money in the Canada Pension Plan. It is managed by professionals. They've done a tremendous job over the years managing that money, making sure it's diversified, keeping the fees low, diversifying in all the different asset classes, and they can make investments much longer term than we can as individuals because they know this thing's going on long past most people's lifetime.
Well, we've often talked about the access to investments, something like the teacher's pension plan has when they own Maple Leaf Sports and Entertainment. You and me as investors can't buy Maple Leaf Sports and Entertainment, but the teacher's pension plan had access to it, and things like the Canada Pension Plan also have access to that type of capital.
Next up is portability. So let's say you're in Ontario and you decide you're going to retire in Alberta. You can transport your pension plan to Alberta. Even Canadians who are living outside of the country, because they've paid into this, have access to their Canada Pension Plan. In fact, the reverse is true. We actually have a lot of clients who've got UK pensions, Australian pensions. Even though they're living in Canada, they still receive those pensions from those other countries.
Again, these are things you put into. This isn't the government's money. You always got to remember this. This is not the government's money. This is your own money in this plan.
Next is what we call long-term sustainability. It's kind of like an insurance company is in that they know what their long-term commitments are. They can do calculations based on how old everyone is and how much they're going to have to pay out in any given year. So they can structure that portfolio perfectly to match that. Plus, they've always got new money coming in. So you've got money coming in, money coming out, and they're able to keep all of that in line.
We're probably at the height of the problem. In the past, when we started doing this many years ago, the biggest fear was the CPP running out, right? And what was the reason?
There was concerns about how it was invested is one of the reasons.
And the other thing was demographics, because the baby boomers, right? They realized there was this massive amount of people that were going to be retired and they'd be drawn out of the Canada Pension Plan. So you're the youngest of the baby boomers, and how old are you now?
Yeah, 62.
So that means your average baby boomer is now 68 probably, or 69, approaching 70. So we're right in what they said would be the worst time ever for the Canada Pension Plan. And it seems to be going. That, like, everything we used to read about 20 years ago said there'd be massive failure at this time. But there isn't this massive failure now that we're going through it. So, as we make it through this, as they call it, the pig and the python, as this baby boom generation is into their mid 70s, they'll go on to their 80s and start to unfortunately pass away in there. And that will put less pressure on the Canada Pension Plan, and it will get it in a better position as time moves on.
One of the other features of the pension plan is called supplementary benefits. So you've got your basic retirement, but there's also survivor benefits. And so what that means is if you've got a married couple and they're used to two pensions coming in, there's a survivor benefit if one spouse was to pass away. So now that one spouse isn't just getting their own pension, they're getting their survivor's pension as well. Now, it's not like getting the pension twice. There's a reduction, but it's still, you're far better off than you would be if you were just receiving your own pension.
And the survivor benefit starts when you pass away. It doesn't start at age 65. So if you put into your Canada Pension Plan, when you pass away, your spouse instantly gets a survivor benefit all the way up until they're 65. Then there's a combined amount that they receive on their CPP. It will generally not go over the individual max, but it's there. There's also death benefit on it. So if someone passes away, CPP pays a death benefit of $2,500 out to the estate or the surviving spouse.
Now, $2,500 does not sound like very much, and that's probably something they need to work at. Maybe boost that up to $5,000. It hasn't been going up with the rate of inflation. I think it's been $2,500 for
as long as I can remember.
a lot. It may have been $1,500 earlier in my career, but it seems to have been stuck at $25,000. Regardless, you're not getting the full amount back, but you're at least getting something that is going to help with funeral costs, etc. What about the guarantee? Most pension plans, the guarantee is that the company's still in existence. What's a Canada Pension Plan guarantee?
Backed by the Canadian government, which I know some people say they don't have confidence in, but remember the Canadian government has the ability to print money. And at the end of the day, there's all type of economics theories about how damaging that can be to inflationary costs and all that. But at the end of the day, the Canada Pension Plan will always meet its obligations.
So, quite simply, it's backed by the Canadian government, which should give it a AA or AAA rating, and you can retirees can be assured that pension's going to continue throughout their lifetime. So there's two, in the financial world, we think of there's two big risks that people always talk about and worry about. And one is longevity risk. So the risk is of running out of money. The advantage to the Canada Pension Plan, it's actually going to pay you that pension indexed to inflation for the rest of your life, to the day you die. So if you happen to make it to age 99, you're still getting that Canada Pension Plan all the way to 99. It doesn't stop at 80 or 85. The second thing is, one of the other concerns people have is what's called sequence of return risk. So if you are managing your own pension plan and you retire and the first 2 or 3 years are really bad in the markets, you may have a reduced income for the rest of your life. With the Canada Pension Plan, you don't have that risk. Overall, Mike, what are some of the things that you are, most pleased with? What does it really provide to you?
Well, it generally gives you, it's regarded as one of the better pension plans and in the world. It's comprehensive. It's got financial security, has sustainability, has adaptability, and it can adapt to all your changing circumstances over your life. So it's very robust, a very strong pension plan. You watch people that come from different countries in the world. We talked about Europe has pretty good pension plans too. Europe may be even above the Canada pension plans from some of the ones I've seen financially. But when you look at other parts of the world, it's pretty strong. You have Canada pension plan, you have the European pension plan. Social Security in the U.S. is actually relatively strong too. But you travel anywhere outside of those areas, you basically have zero.
One of the things you can do is you can actually contact Service Canada to find out what your pension benefits are going to be. There is also an online pension calculator. My suggestion is to call them and get them to send you an updated report. I think you'll get more value out of that than trying to do your own math with the calculator and figure out whether you're actually working when you were 21 years old or not.
Yep.
It's somewhat confusing. Anyways, that today is the Canada Pension Plan. That brings us to the end of another week. Thank you for joining us. This is Rob and Mike with Think Smart from the McClelland Financial Group of Assante Capital Management, reminding you to subscribe so that you can have your best retirement ever.
You've been listening to the McClelland Financial Group of Assante Capital Management Limited. Assante Capital Management Limited is a member of the Canadian Investor Protection Fund and the Investment Industry Regulatory Organization of Canada. Insurance products and services are provided through Assante Estate and Insurance Services Incorporated. This material is provided for general information and is subject to change without notice. Every effort has been made to compile this material from reliable sources. However, no warranty can be made as to its accuracy or completeness. Before acting on any of the previous information, please make sure to see a professional advisor for individual financial advice based on your personal circumstances. The opinions expressed are those of the authors and not necessarily those of Assante Capital Management Limited.